All right. Hello, everyone, and welcome to the Dividend Power Hour. We had a little camera issue there, but now we are off and running. So hopefully you guys can see me. Hopefully you guys can hear me. I know it's been a couple weeks since we've done our Dividend Power Hour. I've been out sick for the past, it's been pretty much 2 weeks now. I had no voice. I had to gut it through those two option workshops that I had. I was able to muster those up. But besides that, I've had bronchitis and haven't been able to shake it at all. But now we're back off and running. Went back to the urgent care, got some new meds, and got pretty much my voice back. So if you still hear me cough a little bit throughout the Dividend Power Hour, then you'll know why. So I'm sorry for that ahead of time, but it's good to see all of you, some familiar faces, hopefully some new faces, hopefully some of those that were part of our options workshop, which was a big hit there. So definitely, it was great to do that. We're definitely going to do more of them, whether it's options, whether it's looking at different, breaking down the financial statements, whether it's a valuation workshop. We're definitely going to have, little bits and pieces throughout the rest of the year. So definitely make sure you stay tuned for those. We even have some new merch that we're starting to put together here, the little dividend seeker with a bull. So we got a lot going on. How have you guys been? Let me know where you guys are tuning in from. Let me know what stocks have you been buying. I know it's been a couple weeks, so there's probably some, in the past 2 weeks, you've probably been doing some buying or selling. So let me know where you're tuning in from. What have you been buying lately? In the comment section. This whole entire Dividend Power Hour is meant to be interactive. I'm going to go through our typical slide deck, look at some of the key important factors that are going on within the economy, and just talk about those. But also it's a time for you guys to interact, ask questions that'll either be answered by myself or some of the great people that are in the comment section below. I see Jim is in there. Jim was one of the first to comment today. Let's see. Mark, great video on the getting dividends every month. I own all three. So yeah, if you haven't checked that video out, that's my latest video talking about monthly dividend payers. I've done videos in the past where you take quarterly dividend stocks that pay in January, other stocks pay in February, other stocks pay in March. You could really have a dividend coming from 3 different stocks. They'll be coming at 3 different times. These ones are monthly dividends. So 3 stocks, all of them pay every single month. So definitely check that out there. We got Tommy in the house. Tommy, good to see you. Gretch, a returning viewer there. Good to see you, Gretch. James as well. Looks like today is going to be the Dividend Power 55 minutes. We'll see. I hope I can make 55 minutes with my voice. So Jay is in the house. Good to see you, Jay. It is that time of the week, Ryan. It is exactly that time of the week. So good to see you. The brown guy. Hi, Mark. It's been a while. How are things? I am still recovering, but this is the best I've felt in literally the last 2 weeks. So it must be something, my voice knew that it was time for another Dividend Power Hour. There's been a lot going on. We closed out September. I didn't have a Dividend Power Hour after the close of September. The markets rallied here at the beginning of October, starting to reach an area of resistance right now. So there's a lot going on. So I'm excited about today's live show. Hello from Portugal. Awesome. Good to see you. Drew checking in. MPLS, Minnesota, Minneapolis, for those of you. Cape Coral, Florida. 2 portfolios, 400K in one, 5 BDCs, 2 REITs. I've got 7 years. Let's go. Love it. All right. Took some profits. Let's see what Gretch is doing. Took some profits on SMCI and Palantir. Alejandro, good afternoon from Spaniard living in Costa Rica. Awesome. Shane, Ohio, bought some Pepsi. Pepsi is, curious if you bought that before or after the earnings, but Pepsi and KO, Coca-Cola, have just been, all of a sudden, everyone here in America is all of a sudden going to start eating healthy. I don't care if you have a diet that contracts your stomach a little bit, you still have to eat. And the choices that folks are going to make on what to eat, I'm going to be a betting man saying it's not going to be a chicken breast every day. They're still going to say, okay, well, I can only eat so much. So I'm going to have a cookie still. I'm going to have my Coca-Cola, my bag of chips. It's not, it could have a small effect on some results, but not to where we're seeing, 20% drawdowns on market cap for these large companies. They've been through it all. So I don't think that's going to change anything. That's kind of my thoughts on Pepsi and Coke. I own Coke, not Pepsi. Speedway, Indiana. That just sounds like a cool city right there. Speedway. I live in Speedway. James bought some realty income. There's the first cough. Some Simon Property Group, U.S. Bank. We got the bank earnings coming up tomorrow, and some Vici Properties. Okay, so he went REIT hunting. Good sector to keep adding to there. Just so you guys know, I got my water over here. I got my hot tea. So we're going to make it through this. Tommy picked up some ADC, Agree Realty, some Maine, and some, oh, boom, there we go. Tommy pretty much just did a monthly dividend stock video right there for you. That is quite hot. Don't drink that too fast. All right. Jim is going defense hunting here. He's got some General Dynamics, LMT, and RTX. Okay, all three of them. What about L3 Harris, Jim? You know, I did a video 2 videos ago. L3 Harris is one I like a lot. RTX is obviously one I like a lot, just given the overreaction on the on their little parts hiccup. You know, it's going to be something that's going to cost them some money to replace. But at the same time, it just seems way overdone in terms of how much the valuations come down, how much market cap has come down. When you look at that, you lose something like $20 billion in a matter of a month. And this issue is estimated to cost us maybe $1 billion. I don't know what the estimates are yet, but $1 billion, you could see kind of the disconnect there. So definitely, if you're a long-term investor, value hunting, looking for some defense exposure, I think it's, the unfortunate things that are going on in the Middle East right now. I think that this kind of shows why it's always important to have some exposure in some shape or form to defense contracts, because you never know when these pops are going to come, especially with a lot of geopolitical issues as well going on. Dazine, I think is that the way I say it? Hey, what up, dude? Dazine from Jersey City. Good to see you. Hello from Baltimore. Always collecting some ABR. Okay, Chris, nice. You got monthly ETFs. Got some SCHD, DGRO, and O. Kath, good to see you. The J, thank you. I appreciate that. I'm getting there. Still coughing a lot. I'll probably have coughing attacks after this show, but we're going to get through it. Christmas in September. I'm only adding to the time to sell was 3 months ago. Okay, the J's looking for a Q4 rally, which we're going to talk about today. Did buy some TGIF. More for fun than anything. Love it. All right, you guys are just buying up stuff. I love it. This is great. Bots. We got the Thrill, SCHD, Target, BMY. BMY has just been struggling, man. And some T-Row there. All right, this is what I was looking for. I was like, man, did anyone buy any Hershey's? Hershey's is one I've been looking at very closely. So definitely, take a look there if you're looking for some value hunting. Hi, Mark, buying some KO. I like that. All right, let's get into today's Dividend Power. You guys are awesome. Let's just keep things rolling, keep it active in that chat room there. So we'll have slides going up. We will have side by sides, and if you guys have questions, you pop them up. So here's our normal economic outlook thing that we got. Normally, if you guys are normal on this show, regulars on this show, this is nothing new to you here. So we like to first start off with, what is the stock market doing? Here's our 3 major indexes. We got the Dow Jones up 1.5%, still holding on to that slight gain there, and they're actually up that 1.5% in the last 5 days, pretty much since last Thursday. The S&P 500 is up 13.3. The NASDAQ's up nearly 30%. You can see all 3 indexes in the green over the past week there. Valuation, analysts are looking for 247 in terms of EPS next year for the S&P 500. So let's go and take a look at what we're talking about here. So as we always like to do, bring up the Yardeni research. You could see here they publish these pretty much on a weekly basis, and you could pretty much just type in S&P 500 EPS estimates. It'll show you all the estimates and actuals from years prior. And then for the most recent years and the years moving forward, you can kind of see it broken down into quarterly as well. So here we are in 2023. We think we're going to be right around 220. We've had, 2 negative quarters in terms of contracting EPS. They believe it's really going to be around even here in Q4. This is, again, average analysts. This is Yardeni over here. They're always a little bit more optimistic, I should say, in terms of things. So you can kind of take which one you want, but they're both, rather close there. And they're both, this is more than just one firm, I should say. So Q3 is when they think they're going to start making the turn here. We've had these 2 drops. We're going to be right around even until Q4. That's when things start to bring back. We're going to get some earnings. 9.3 EPS growth is pretty solid. But look at 2024, what they have. Pretty much double digits EPS growth every single quarter. Now, one of those things is going to be softer comps from this year when we saw some retractions. But the numbers are, well above pre-pandemic levels. So we're talking about we are back off to the races here. And there's a lot to be excited about. So that's this 247 here. That's the full year. When you look at all of these here, 247 and 17. So that's where I'm getting when you look at the valuation here, 224 EPS of 247. That's where I'm getting that number from. So that gives us, as of the end of today, S&P 500, our price to earnings multiple of 17.6. The 10-year average is 17.4, which is where we were last time we had our Dividend Power Hour, which was the end of September. I think it was the 28th. So in the past 2 weeks, we've seen the markets come up. We've kind of rebounded here in October, and that brought up the multiple as well. So interest rates continue to be way on stocks, and valuations. They're sky high right now. No one wants bonds. The bonds are selling off here, which brings the interest up. So our 10-year interest right now on our 10-year bond yield is 4.7. Last week it was at 4.6, call it, round up. The 2 years at 5.08, which is pretty much in line with where we were. So we could take a look and see where are these yields going? What have they done all year? And it's pretty fascinating here. So here's our 10-year. If we click on our 10-year year to date, you can kind of see we started right around 3.7 and we have just climbed high. As all the way to the end of September, we got up to 4.8 on the 10-year. We did have a dip, but we've kind of rebounded from that. We went down to 4.56, and we've again rebounded up to 4.7. Go over here to the 2-year right now, where you can get decent yield there. Click on that. So here's our 2-year. There's our yield there. So we started right around 4.3 on the 2-year, and now you can see we are up over 5, yielding over 5% on the 2-year there. So definitely quite fascinating in terms of where yields are. And again, higher yields weigh on stock valuations there. Employment every Thursday when we do this show is the same day that we get employment updates. So jobless claims every Thursday for the week prior. So jobless claims increased increased by 2,000 up to 209. Economists were looking for 210. So not a big sway there, but again, it's under estimates. Continuing though, that's the one that I like to look at. Who are the folks that, okay, they were on the jobless claims last week, but everyone from the week prior that remains on the list, where's that number going? Because, the week by week stuff, that can be a lot of seasonality that can come into that. So continuing we're at 1.72 million people that are unemployed, continuing to collect unemployment. That's an increase of 30,000 from the prior week. So that was kind of interesting that I got out of that. That's actually the highest level that we've seen since August. So something to definitely watch there. But when you look at employment, take a step back, look at it as a whole, the labor force is quite strong. The thing you want to look at is, okay, jobless claims will tell us how many people are getting, is there a big spike? Is there something coming up? You can kind of see that in the jobless claims there. But when you have continuing that remains low, that means, okay, people may have gotten laid off, but they're able to find a job rather quickly. When the continuing unemployment starts ramping up, that tells us that, okay, people got laid off and they're not finding jobs as quickly. That can kind of raise a red flag when it comes to the economy as a whole. So definitely something to keep an eye on there in terms of employment or unemployment. But however, the unemployment rate is still quite low, so nothing to kind of panic about there yet. We got CPI results. Those came out today. That came in a little bit hotter than expected. We were hoping this inflation thing, higher interest rates for, the past 18 months that we've seen, this incredible run of hike, interest rate hike. Is it starting to take its toll on the economy? Inflation is still high, and we've talked about it. If you've been on this show for at least the past month and a half minimum, then you've heard me talk about inflation. My expectations is that inflation is going to remain sticky. A lot of people are hoping, okay, the Fed's going to get back down to 2%. We're going to stop rates. We can start cutting. No, that hasn't been my vision at all. So I continue to think inflation is going to remain sticky. We now are seeing inflation actually tick higher here. So 3.7% year over year, nowhere near. I mean, it's closer than 9% where we used to be, but still not close to where the Fed is hoping to get. Expectations were 3.6, so we did come above expectations. I looked at a thing yesterday of all the analysts and banks and everything that were putting out their estimates. Every single one that I saw was 3.6. Like everyone was believing. It wasn't like it averaged out. Some were 3.7, some were 3.5. Every single one of them was 3.6, and there was at least 20 that I looked at. So everyone was really honing in like, oh no, this is 3.6. This is in the bag. Boom, it pops up 3.7 today. That was kind of interesting there because the stock market this morning started off quite negative. And I thought, okay, maybe we're going to get. I wanted to let things play out, so I didn't, go in and make any options trades or anything like that. Let's see how it plays out. And then thankfully I did that and didn't, bet a bunch of stuff to the downside because lo and behold, what does the stock market always do? Boom, it rebounded. And it rebounded, had a big rebound. Everything moved to the green. And then it changed directions towards the end, and we ended up towards the lows there. So right around probably, I want to say 11:30 my time, which is 2:30 Eastern time. I put on an SPY put. I bought a put, which means, for those of you not in on options, is that if the stock market goes down, the S&P 500 goes down, I make money from that. So that was a short-term bet. It was just expires tomorrow, so it can be higher risk because I only have one day for this to play out. So that one's already in the green a little bit. If we do get a pullback to continue tomorrow, then that one will be firmly in the money and make me some good money there. If it jumps up, I'll probably just sell it and cut my losses there. So that's kind of where I'm sitting with that one option. I also have some covered calls with QQQ, some option spreads. Just looking, I think there's a lot of headwinds right now, short term. I'm a big believer in the Q4 rally, but I think right now we might have to take a little bit of a breather. So we'll talk more about that as we continue on here. And then housing. We are nearing 8%. There's actually some folks that are getting mortgages over 8%. If you don't have good credit, don't have a lot to put down. So in terms of, averages right now, we're hovering right around 8%. That is astonishing. 15-year, not that much better. You're at 17.2 or 7.2. It'll probably be 17.2 here soon. 7.2 and 30-year jumbo, which it seems like where housing prices have gone, pretty much all of them are jumbos right now, at least here in Southern California. You're sitting at 7.93 there. So definitely some interesting things going on in the economy out there. Be curious. In the comments section, what is your current, for those of you that are homeowners, what is your current interest rate that you have on your mortgage right now? I think I'm right around 2.6%, I want to say is what my 30-year mortgage is right now. We nailed it right at the bottom. It's more luck than anything from there, but I'll take that. And that's the problem that's going on a lot right now with no inventory, is due to the fact that you have all these people sitting on mortgages. I think it's something like 90% of folks right now with mortgages are below 5%. So if you sell right now and you go buy a new house, unless you have cash, we talk about it on this show a lot, then you're going to be paying an 8% mortgage. What you can get 2 years ago compared to what you can get today, just with that interest rate, if you take a $400,000 loan 3 years ago, 2 years ago versus today, it's pretty astonishing the difference there. So what interest rate do you have for those? Fabio, 2.75. Wow. Sharp's Law paid off 3.3 2 years ago. Awesome. Mike's at 2.25. Nice. That is awesome there. That's hitting the bottom right there. Curious if that's a 30-year or 15. Cass at 3, Jim's at 3, right around 3. PMH is 3.35. Steve had 3.2, but it expired. Got it. Awesome. Yeah, let me know. Keep those coming in there. All right. So inflation, and we just talked about it. Inflation is still a problem here in the U.S. So CPI came in higher than expected. We saw month-over-month growth of 0.4%. So not even looking year over year, if you want to say, oh, the comps are different, but month-over-month, which, it was high last month, we ticked higher by 0.4% there. We already went over year, 3.7. Analysts, economists were looking for 3.6. Core CPI, though, which we didn't talk about, core CPI excludes energy and food costs, which have a lot more volatility. I mean, You see it in the gas prices. I think energy was up almost 2% when I looked at the list. So it excludes that. Gasoline's been going through the roof. I think I'm at $6.50 here in Southern California for a gallon of gas, and that's probably Costco prices. So core CPI was up 0.3% month over month and 4.1% year over year. So this is the core CPI is really what the Fed is focusing on there. So still, something over 4 is not great there. That was in line though with economists. So no surprises there. The largest driver though was shelter costs. Those accounted for more than 50% of that entire, 3.7%, 4.1% CPI versus core CPI. 50% of that increase was due to shelter costs there. And the fact of the matter is we have higher inflation. It costs more to buy a basket of goods now, and we're starting to see average hourly earnings moderate. So all of that went into this higher, CPI, and it's just making it more difficult for folks. Your purchasing power continues to erode there. The cost of items, food, basket of goods is increasing, and average hourly earnings are decreasing. We saw those fall 0.2% just on the month alone. They are up 0.5% year over year, but as we see, that is not outpacing inflation there. So there's a lot of underlying issues there. And the fact of the matter, the economy has been able to withstand a lot of this is due to the fact that during the pandemic, we were able to save so much money. I mean, we went from very little in terms of savings and then it just skyrocketed. But if you look at these savings rates, those have just been eroding, and they're not just like layering off. They're just getting sliced off to where a lot of people here in the US are pretty much down to the last pennies in savings. And what does that do? That leads us to higher credit card debt as well. And we've seen higher credit card debt reach and surpass over $1 trillion. So credit issues are starting to be something that you really want to focus on, especially with bank earnings tomorrow. We got bank earnings coming on tomorrow. That's going to kick off this Q3 earnings season. So what are we going to be looking for? Higher interest rates is what we liked with banks before. I own Bank of America. That's really my only bank exposure. I have some Schwab, which is more investment banking there. So not a traditional bank. Big bank is Bank of America, right around a middle position there. Not a huge position for me. Interested to see though. I don't have great insight into what I'm expecting, but when you look at valuation from a long-term perspective, the CEO there, Brian Moynihan, is a fantastic leader there. A lot of people compare him to Jamie Dimon. The problem with the top two in terms of quality is JP Morgan and Bank of America. However, with higher interest rates, that gives you better net interest margin. But with economic activity really starting to erode a little bit, if you can't get a ton of loans when the interest rates are high, well, then that doesn't really help you in the long term. To get higher net interest income, net interest margin, you need more activity. So if the activity slows up, that's a concern. The other concern really is credit losses. Now, I think these big banks are going to do a fine job continuing to reserve for that. And what I mean by reserving for that, they're setting money aside for if they have loans that default. Okay, we saved that. We have that bucket here. That's gonna take care of that stuff. But when you save for losses, that's also a loss on your P&L. So if you want to say we have a loan for $1 million, you can't just book $1 million of revenue. It's going to be booked as collected over time on revenue, but you have to set aside some for credit losses, and they continue to build up that credit losses in anticipation of defaults coming forward. So we really want to be careful and be mindful of what is going on in terms of credit. If you own big banks, if you're looking at banks, any banks at all, you really want to focus in on, that's what the investors are going to be looking at here. Any verbiage from management about potential credit losses? What is the actual reserve that they did this quarter? That's going to be things that we're going to be focusing on there. So what else do we got here? Checking the comments here, make sure Chris paid off his mortgage a year ago or years ago. Sam is from Australia. Panama is in the house. Good to have you. Do you read the comments? I certainly do. Jim's got JP Morgan, US Bank, and New York City Bank. So he's got some banking exposure. All right, how do you feel, Jim, about the banking season here? Earnings season kicking off with the banks. You feeling good about the banks' earnings, or you got some concerns about them moving forward? Chris, I like SASR for bank stocks. SASR. What is SASR? Not familiar with that one. Sandy Spring Bank Corp. Got a market cap a little bit below $1 billion. Down 41% over the past 12 months. I haven't looked into that one before. PMH has got some JP Morgan and UMBF. Jim, he does read the comments. He'll catch up after prepared presentation. Jim feels good about JPM. The others not so much. It's kind of been the consensus that I've been, hearing a lot of as well. NASCAR, if you asked a question, I do not see one here. So, here we go. I did miss it. There's a guy on YouTube who is giddy about the stock market being very similar to 1987 market before Black Monday. So I'm obviously not that guy. I think we could have some headwinds here in terms of earnings are going to be interesting, and we're going to talk about that more in the slides here. Is the fact that I think a lot of the macro headwinds are priced in, the things we've been talking about on the show, the things we've seen in the economy, inflation being sticky, rates higher for longer, that type of stuff. One more rate hike priced in. A lot of this macro stuff I think is priced into the market. We saw a pretty bad September. Came as no surprise though. September historically the worst month in the entire year for the stock market. But I think it's going to come down to now is being a lot more focused on quality, the quality of the stocks. Sure, you could have stocks in the banking sector and banks not doing quite well, but if you have high quality banks, it's really going to be, JP Morgan. They're going to still have robust loan activity. They're going to still have fine net interest margin. Is any net interest margin going to be great for any of these banks? No, I don't think so. But there's going to be big differences you will see from bank to bank, and that's where you start making your picks. If you want to own banks, I'm probably not taking a holistic approach in terms of ETFs right now. I think it's more of a stock pickers game just in the short term. That doesn't mean go away from your diversification, diversify your portfolio first and foremost. But if you're looking at individual stocks, I think it's going to be more of a stock pickers thing. You got to look for what is the highest quality in that particular industry, sector, whatever it may be. And that's where you have to understand about how do I look at valuation? How do I review an earnings statement? Or how do I review an earnings report to see what's going on for these particular companies there? Kevin is in Bank of America, not very happy with that position, way down. I feel you there. Sam, I have Bank of America and BNS, keeping positions smaller though. I like that. JP Morgan does get us started off tomorrow. I think Wells Fargo tomorrow, if I'm not mistaken, will kick it off as well. So let's get back to the slide deck here. So we talked about inflation. Here's another look. As you guys know, if you've watched here before, I'm a visual learner. So I like to put different slides in here for you guys to see what we're talking about. So great. CPI is at 4.1%, 3.7%, whatever it may be, if you're looking at core or non. But what is that? Where has it been? Where's it coming from? If you're not familiar, well, hopefully this helps you, because this chart shows how has CPI tracked since the pandemic. Well, that little shaded gray area on the left side of the chart, that shows that little recession that we had in 2020, a pandemic-induced recession. And then you can see how inflation after 2021 skyrocketed to over 8%, reaching 9% on a CPI-related basis. Core CPI kind of flattened out around 6 or 7% or so. But then we dipped all the way back down. Folks were getting really excited about, where is inflation is just continuing to erode away, and we're going to get back to that 2% level that the Fed wants. Well, lo and behold, in the past few months, inflation has returned and kicked back up there. Part of the reason is, we've had these for the past, who knows, however many years prior to this, we had a free money. So there's a lot of printed money that was put into the system here. That's what the Fed is fighting against there. So that saving stuff I'm talking about is one thing. Another thing is unemployment is quite low. So folks have jobs, folks have money. That leads to being able to buy things that maybe they don't need and they don't care the price right now. It's going to start mattering though sooner rather than later. So inflation is something that I don't think is going to go away anytime soon. A quarter or two. I think it's going to be here for a little while, and the Fed continues to have its work cut out for them. So Another area that's struggling and I believe has a lot of downside is real estate. And if any of you are out there that are real estate experts, I don't call myself a real estate expert, although I've worked in home building for over 6 years, not any longer. This is what I do full time now. But prior to that was in the home building sector. So, a lot of familiarity with it. As we saw the last time we met, pending home sales fell 7.1% to 71.8 in the month of August. So we'll see, or that should say September. Interest rates still right around 8%, as we saw. That has an effect, especially if you're a first-time home buyer, really any buyer. But if you're just getting into the home for the first time into the real estate market, that's got to be a tough spot. So, housing prices have went up. So now you have a combination of higher housing prices and an 8% mortgage rate. Not a great combo there. But, if you're a patient person, I think you're going to get some relief, I think, in some of these with prices coming down. Existing home sales are just, it's struggling. Where a lot of the positive news has been is with the home builders. Home builders stock prices, if you look at those, have been doing quite well throughout the year. But part of the reason when you look at those home builders and peel back the onion is due to the fact that they're subsidizing these high rates, incentivizing a lot of buyers to come in. Hey, we will buy down your loan. They do these. It's like a tease loan. You say it's called a 3-2-1. They'll buy down your loan 3 percentage points in the first year. That goes down to 2 percentage points in the second year, 1 percentage point in the third year, and then you're stuck with your regular loan in the years after that, so on and so forth for the remaining 27 years. So it looks great for the first 3 years, and then boom, you're hit with your normal mortgage. That's going to be around 8%. That could be a big wake-up call, especially for a lot of folks that aren't great with money, responsible with money, planning out things like that. That could be a big hit to the market as well. We do have, on the flip side, though, that takes away a lot of that negativity, is the fact that we still have a housing supply shortage of roughly 4 million units based on demand of folks looking for a home. It's roughly, estimates say, around 4 million plus. So these are some reasons, though, I believe still, the home builders can't be subsidizing this forever. There's a cost that comes with it. I believe over the next 12 months, I think housing prices are going to come down. Where we see interest rates is kind of anyone's guess right now, but you can't have the demand like this of folks just jumping into 8% mortgages and high prices like that forever. And you can't have home builders subsidizing. They've even talked about it on their earnings calls about, this coming to an end, or certain programs that they have. So very interesting there in terms of housing. So I don't know if you guys have any comments, if any of you are real estate or experts, or what you've seen in your markets in terms of housing coming down, or housing prices going up, maybe new home construction going up. I live in a new home area, and they're still building, like crazy out here. It's not like it used to be, but it's still, robust. So homes are still going up. Whether they're getting sold or not, I'm not keeping up with that type of information in my particular market. But it does. We still have some inventory issues, and I think there's going to be something's going to go on with real estate there. So, all right. So now let's turn our attention. We talked about CPI. We talked about real estate. Now let's talk about PPI, which is also, it's the producer price index, Mr. R there. But PPI rose. That came out earlier this week. That rose 0.5% in the month of September. Economists were looking for 0.3%. So that was another upside. We saw CPI up over expectations, and we also saw PPI, which started us off this week, being higher than expectations. So not a good run there with both of those. Core PPI, again, very similar to core CPI, pulling out those other two things. That was at 0.3%, and again, higher than economist estimates of 0.2% there. So some concerning things there, because some of you might be saying, well, what's PPI, what's CPI, how should I use it, how should I look at what's the difference of them? PPI measures the price. That's the wholesale price. So the person that's buying the raw materials to create the finished good, and then how much they're selling the finished good to a shopping center, to a retailer, whoever it may be. That's the PPI. So it's really down the line from where consumers are going to get it. So this can kind of be an indicator looking forward of, okay, is the higher interest rates starting to take a toll and give us some relief on inflation, or are people, because remember, manufacturers, if they're creating a product and they have to pay more for a product, they're going to pass it on to the retailer. If the retailer has to pay more for a product, they're not going to sell it at the same price. They likely have to increase their prices, and that passes it on to you, the consumer. You can kind of see how the flow goes here. So it really begins with PPI. So definitely a key one to look at. And I think, in my opinion, this is really one that the Federal Reserve looks at too when looking down the line. Are we making headway when it comes to inflation? So it measures the cost for finished goods that the producers pay. An example here, a wholesaler, what they're charged for the raw material. Maybe they're making a jacket or a shirt. What they have to pay for that. How is that increase for the raw material? They make the shirt, and now what are they charging the retailer to go hang that up and sell that to you, the consumer? That's how you can think of PPI is different than CPI. CPI is buying the finished good, buying the basket of stocks, buying the banana from the grocery store or whatever it may be, supermarket, buying the jacket from Target or Walmart. That's more a way to think of CPI. How Target bought it from whoever made it, that's more PPI. So 1 month performance here, you can kind of see what has the, we talked a lot. If you go back to all of my live shows for the past 3 to 4 weeks, we have really raised red flags, concerns. We said, hey, September, just so you know, historically the worst month in the market. We have headwinds here. Be concerned about this, blah, blah, blah. And hopefully you guys took note of that. Hopefully you guys, appreciate what we're talking about here and the research that we do. And you could see September was not a good month. It was very poor. We saw S&P 500 well over, down 5% during the month of September. But now you can kind of see that bounce, and that bounce really came at the start of October. You could see right when we turned the page, there was a lot of buying, and we've seen an uptick here since that. If we looked out over the past, 2 weeks or so, 12 days, I would bet to show you that we've had big time numbers for October. Not big time, but bouncing the right way. But you can still see over the past month, the indexes are still down. So we have S&P 500 down 3% or so. We have Dow Jones down 3%. We got NASDAQ down 2.5%. So we're trying to make up for those big drops we saw in the month of September. So that gets us to our first question of the day. Or is it our second or third? I don't know. But do you believe we will see a fourth quarter rally? Let me know in the comments section below. Are you a believer in a fourth quarter rally? Do you think, okay, we had a rough September, that's historic, but now we're going to turn the page and we're starting to get towards those higher EPS, higher optimistic numbers that everyone is kind of looking for? Let me know in the comments section. I'll give you about 30 seconds. All right. Before we get to that, while you guys are still commenting there, let me tell you about my 6-week investing accelerator course. If this is your first time joining our live show, welcome. My name is Mark Rusin. I am a CPA. And one of my flagship offerings that I do these weekly videos. I put out videos on Mondays and Wednesdays, and we do a live show on Thursday. Thinking about potentially mixing those up, and would love to hear your guys' opinions on those as well. Might be thinking about doing a video on Monday, a live show on Wednesday, same time as what you do this one, but on Wednesday instead. And then my second video on Friday kind of breaks things up. And then we have, it's pretty much every other day we have content coming out, either an edited full out video or a live show split in between those. Let me know what you think of that. But in addition to that, what I do outside of videos is I have a 6-week investing accelerator course where I work with students, clients one-on-one. There's 60-minute sessions. We do it over 6 sessions. You can do it once a week, which is what most folks do, or you can come in if you have more time and want to learn faster. You say, hey, let's do it every 2 to 3 days, and we schedule that out based on your need and your flexibility. I do them all parts of the day. I do them from all over the world there. I did someone from Australia, so if I can make that time zone work, I can make any of them work. So whether you're new to investing, whether you've been investing for 1 to 5 years, and you just like, hey, I want to learn more about this. I want to learn what this investing stuff is. I've just thrown money, throw darts at the wall and pick stocks like that, or I just have an ETF, or I haven't even opened up a portfolio yet. You're the perfect candidate to come through this, because this is going to be your building block, your foundation moving forward. We put together a customized strategy, a customized action plan for you to take with you, not just in year 1, but for years down the road. And that how you are as an investor is the trajectory on the path we take through this course. Every course isn't the same for every single person. I have people that come in and want to focus on growth stocks. I have other folks that say, hey, I want passive income, or people that come in and say, I want somewhere right in the middle. So we kind of touch on both of those. So you're learning about all the different options available to yourself and how to value stocks. What metrics do I look at myself? We do portfolio reviews as well, all during this 6-week course. I only do 7 of them each time we open up. So we have enrollment that just opened up again. So if you are interested in doing this and getting in on the next one, definitely check out the link down below. You can sign up for a free investment evaluator to learn more and get signed up that way. So check out that link. That's that little plug for that. And hopefully we'll see you there. So let's see. What did you guys think in terms of a fourth quarter rally? Gretch says maybe 60% towards yes. Yes, of course. Holiday season, the J. I love the optimism. Nas says yes. Santa Claus rally maybe in December. So Jim's not as upbeat on the other months here. What do we got? Possible, but have my concerns. Fair enough. I think you get a modest rally. Okay. Got to rewind, but thank you for the videos as always. You're welcome. Nice, Jim. Might see a rally if the Fed skips upping the rate in November. Okay. Zach, there will be more government spending for Ukraine and Israel, giving money and weapons. Bonds go up, more inflation, stocks take a dive. Okay, that's an in-depth one there that we're looking at. So let me pull up. Since someone mentioned rates, we forgot to look at our normal rate to see where is folks thinking that the next hike is going to be. So our next Fed meeting is in 19 days, 18 hours to be exact. So this is the November meeting. Right now, 87% think they're going to keep things flat. We're going to pause. We're going to take a look at the data here. There's going to be no rate hike in November. And the Fed officials came out and were speaking yesterday, and a lot of them were in consensus. That was pretty much what all of them were saying. I think, we got to continue to look at the data. I think rates are at a good level right now. That was all an indication that we're probably going to stay put here for the month of November, the November 1st meeting, I should say, not the entire month of November. But the next meeting, though, isn't till mid-December, December 13th. And when we cross over to that, you see things are going to change. We're going to go from 87% are saying pause. That drops down to 64%. So where's the other believe? Well, we'll call it 35% believe we're going to get a rate hike in December. And that's that one rate hike that Fed officials have been telling us about. A lot of the stuff that the Fed officials have said, they've actually done. A lot of the time with the Fed, they'll say things and then they'll do the opposite or won't do anything at all. This Fed has actually been saying, no, we're doing 2 more rate hikes. We're doing 4 more rate hikes. And what do? 2, 4. I mean, they've been warning us. They haven't done. That doesn't mean they're doing a great job. Don't get me wrong there, but they've kind of stuck to their word in terms of consensus there. So that's kind of interesting there. If we look at the probabilities, we can kind of see right now the consensus believes we won't get any rate cuts until June of 2024. So that's when the rate cuts in. And again, remember, the stock market moves roughly 6 months before events happen. It's always going to move before the economy. The stock market will start moving higher before an economy bottoms with a recession. The stock market hits a top and starts coming down before an economy hits a top and starts coming down. Usually around, that 6 to 8 month mark is pretty much average for in terms of timing of difference between stock market moves versus what the economy's doing. So, it can be confusing as an investor. You're looking here saying, well, the economy doesn't look all that great. You could be in a spot where inflation's at 4.5%, 5%, and all of a sudden the economy's up, or the stock market, S&P 500's up 5% in the past month. You're like, well, that makes no sense. And unemployment going up and the stock market going up, how's that make sense? So just know that in the back of your head as you're an investor, understanding how the differences are. So right now it's right around June, and still, if you look at the blue here, the majority don't believe we will get a rate hike or rate cut. It's only the highest percentage here is still right around 35, 36% for either December or January, lifting that to 550 there. So definitely something to keep an eye on there moving forward. All right, let's get back to our slides here. So Fourth quarter rally ahead. For those of you that remember me saying September is the worst month, August second worst month for stock market. Q4, if we're looking at a quarterly basis, is the best quarter for stocks. So, we kind of get a turnaround there. So some relief moving back into positive territory. That's historically, is this year anything but average? No. You got things like NVIDIA, Meta up over 200%. You got the Magnificent Seven carrying the S&P 500. So there's a lot of things going on in terms of what's really happening with the economy. So just know that, though, Q4 is, September lived up to its name. Let's hope Q4 lives up to its name. So here's some reasons to be optimistic about a Q4 rally. The labor market's strong. People are employed. And when people are employed, they have money to spend. And when they have money to spend, that's good for earnings, good for margins. All reasons to be optimistic about a Q4 rally. If you start seeing unemployment tick higher, especially as we approach the holiday spending season, that can be a cause for concern. But if you look at the hiring plans for a lot of these, Amazon hiring thousands of people, look at Target, Macy's, whatever it may be, hiring is way up. People are expecting a decent holiday, not a record-breaking holiday season. Prime Day sale was the last 2 days. Those were reportedly very good for Amazon. I'm an Amazon shareholder, so I'm happy about that. I bought a few things on Amazon Prime there in the last hour, I should say. I had about an hour and a half to go. So got some Christmas presents there. Margins are improving, especially for these retailers. If you're interested in retailers, those are improving a little bit there as well. And inflation growth is slowing. So, we're not at 9%. We're down at 3.7, 4.1, whatever it may be. Although it ticked up a little bit, that can kind of go on both there. So let's look at reasons to be pessimistic about a Q4 rally. Well, inflation is still high. We just picked back up on inflation. We went from inflation growth is slowing to, inflation is still well above where the Fed wants. The Fed has told us they plan to keep interest rates at higher inflated levels, higher for longer, something we've talked about on this channel a lot. So you need to, if you're doing your calculations, higher interest rates, higher yields impact stock market returns, impact stock market valuations. So if you're doing a discounted cash flow, that's going to impact, because if you can go out and get a 5% pretty much guaranteed return, then maybe you're not going to risk it in the stock market. There's a lot of alternative options. Now, there's still a lot of cash on the sideline, which is probably another reason to be optimistic. So, it's kind of a push and pull right now. Higher interest rates for longer impact valuations. 70%. This is another one. We think that the S&P 500 is doing great. Over 70% of all the gains have been from the Magnificent Seven. The Magnificent Seven, if you look at them and take their average return across all of them, they have an average return of 92%. That is anything but a regular year. You can look at it right here. Here's our Magnificent Seven. Look at the returns. The S&P 500, this is as of a few days ago, but S&P is up 12%. But look at that equal weighted. We've shown it on here. The RSP. That shows you that there's a big disconnect between those top 7, which have a decent weighting in the S&P 500, and the bottom 400 plus stocks. They're not doing that well. Are we in a good economy or are we not? Looking at the equal weighted S&P 500 is one way that you can kind of look at that. So, Paris, the 6-week investing course is not working. Could you please repost it? Thank you. Yeah, after this one, I'll update that link for you guys and make sure the latest and greatest is on there. Gretch heard a great saying from another creator. Sometimes you have to risk it for the biscuit. Yep, we've heard that one before. All about taking calculated risks. So again, it's a stock picker's market right now. You gotta focus on quality. So look at these returns from the Magnificent Seven. NVIDIA and Meta are just astronomical. And a lot of analysts are saying that price targets are even baking in another 50% gain from here. Not through the end of the year, but through the next 12 months. That's just phenomenal. NVIDIA is just a monster of a stock there. So again, I just touched on it. Quality is a factor when it comes to stock picking right now in this market. A lot of macro events are already priced in. It's nothing new. Higher interest rates for longer. Higher for longer. That's nothing new. One more rate hike. That's nothing new. Mild recession in 2024. No one's pricing in a moderate recession. No one's pricing in a big time recession. But I think for the most part, potentially we touch a mild recession in 2024, first half of 2024, etc. There's a number of other things that you can look at there. But quality is going to be the best management teams, the most efficient. How do you find efficiency? Look at operating margins. That'll tell you efficiency. Look at balance sheets. Look at free cash flow. Look at free cash flow margin. Look at free cash flow payout ratios. That can tell you how efficient a company is being. Do they have too many folks employed? That impacts operating sales. What are their margins doing? Our gross margins, are they passing it on to the consumer? Or are they eating it? Gross margins will go down or up. Look at all of these things. And that's the important thing of understanding, how do you value a company? How do you value the health of a balance sheet? All the things we talk about in the 6-week investing course, setting you up to be your own money manager. So if that's something that you want to do and take your investing to the next level, definitely check out that link down below. And I'm going to get that fixed at the conclusion of this. So let's quickly, before we wrap up, take a look at the year-to-date sector performance. As you can see here, year-to-date, we're still led by the top two there, being communication services and infotech. That should come as no surprise. Communication services has been Meta. Google's had a great run of late, reaching new 52-week highs. Infotech's all your NVIDIAs, Apple's, Microsoft's of the world. Consumer discretionaries had a good year so far. But then for the most part, you look down, materials has climbed back into the green, but after that, everything's red. Materials was one of those ones that was red as well. Industrial's been decent, but all of them are underperforming. But look at the past month. They're all red. As we know, September was rough. Communication services, though, still squeaked out in the past month, which is as of today. So it's about, half of September and the start of October. But still, even with the bounce back that we saw at the start of October, the past 12 days, every single sector is in the red in the S&P 500. 10 of the 11 are in the red. So definitely something to look at there. So here's a little bit more about the 6-week investing accelerator course. Again, only 7 spots, 6 sessions, one-on-one, 60-minute sessions working with me. I don't pass you on to any other teachers like that. You just work with me. That's why I only can do 7 of them every period that we open up for enrollment. So, and they do go quick. If you're looking for more information, you can sign up for our free newsletter, the Dividend Investor's Edge. That comes to your mailbox or inbox, not your mailbox, to your email inbox every Monday, except for this Monday, because I was pretty much out for the count. So I skipped one this week. I'll try and do one tomorrow just to recap a lot of the stuff that's gone on with the economy, but you'll get a fresh one on Monday. But if you want to take it to another level, sign up for the premium membership, less than $1 a day. You're going to get my monthly portfolio update, which I recently did. You're going to get 2 stock deep dives. We're going to be very busy in the next few weeks because we just started rolling out earnings recaps. You get a nice graph of the latest earnings for that particular company. And we do it on companies. We don't do it for all companies. We do it for companies in our coverage ratio or in our coverage area as well. So definitely keep an eye out for those. Give us a try on the premium subscriptions. Get on our email list. We send the emails out throughout the week, giving you updates on a lot of the information at workshops, videos that have come out recently. So all that great stuff. So before we go, any questions? And Jim just reminded me, make sure you hit that like button down below. And on any video that you watch from me, I put this content out free on YouTube to watch. So that's a way of saying thank you just by smashing that like button. It helps, with the algorithm and helps, Google push it out, YouTube push it out to more people there. So, as always, we had when I was looking there, we had over 100 people viewing. So that is just fantastic as we continue to grow here on the Dividend Power Hour. Thank you guys for joining me. Any questions before we wrap up this Dividend Power Hour here? So, Gretch, your voice made it through. It did. We'll see how it does when I hit that end stream button, though, because I can usually hold it together for about an hour in my teaching sessions. I had one today and had a couple of coughs, but no coughing attacks. This bronchitis has woken me up in the middle of the night where I had coughing attacks, can't go back to sleep and stop my heart from racing. So it's been a rough couple of weeks, but got some new meds yesterday, a steroid that's kind of opening up and releasing the inflammation. So that's definitely been very helpful. So thank you guys for all the well wishes. And then, I have on YouTube right now, if you go to my community tab, I have a poll out there right now, just seeing what type of videos do you guys like? What is your favorite videos that you watch that I put together? Is it talking about REITs? Is it talking about cheap dividend stocks that I'm looking at? Do you want some new type of videos? Maybe like, once the hedge fund managers start reporting their 13F filings on what they're buying, what they're selling, would it be cool to put videos together on, what was Warren Buffett's latest buys and sells, and Ray Dalio, and any other, Tiger Global, looking at, what are these guys doing? What are they buying? What are they selling? That's kind of an idea there. And different types of videos. Do you guys want some that are non-dividend stocks, looking at growth stocks? I don't do cryptocurrencies. So, very open. Just want to always see what you guys enjoy watching. So definitely check out that poll and let me know. So, thank you, Jim, for that comment. Tommy, you have a good evening yourself as well. Thank you. I really appreciate that. Jay, thank you so much. I really appreciate that. Thoughts on EMN under my cost basis? Under my cost basis, thanks. Well, let's take a look here. So materials have actually had a nice little rebound of late, but Eastman hasn't been one of those ones that I want to compare it here. Not that these two companies are comparable at all, but I'm kind of curious because I've been following Albemarle, which is a lithium company. Again, still in materials, but let's pull up this here so you guys can see what we're talking about. So here's ALB. That's their stock ticker. Pays a dividend, not a big one, 1%, but it's more on the growth on lithium. This is the kind of the growth on EV. And you can kind of see how this is where materials started to make their move. And the fascinating thing that I see when we kind of compare that to EMN is the fact that it hasn't partaken in that. So, that's definitely something to look at. But you're getting a PE ratio of 11 times. Let's take a look at the fast graphs chart just before I put my foot in my mouth and say something I shouldn't in terms of valuation there. So let's do that. I don't want to see me type in all my stuff here. I don't want you to. I don't know which it is. So here's the fast graphs chart. We could pull it up here, go to adjusted earnings. EMN, a lot of stuff that you guys see when you watch the videos before. This is where I get those charts from. Fast graphs, it's a great tool. It's a paid tool, not too expensive, but it kind of shows you. So what this is telling us is you can kind of see, well, EMN has been having decreases, obviously, in their EPS as of the last 2 years. You can see down 11%, projected to be down 15% here in 2023. 2024, though, there's some big rebounds here. And I think that's last time I looked. I haven't looked at this company in probably 3 or 4 months now, but you're getting that boost that has been expected with them. 20% growth is very solid, albeit it's coming off of -15, -11, but it kind of continues moving forward into 2025. A lot of big prospects for that. So when we look at just on PE ratio alone, if we take 74.23, let's divide that by 805. That's this number right here. That's projected forward 12 months EPS from there. That gives you single digits, them trading at 9.2. Now, if we look out over the past 5 years, you can see that they're closer to 12. So there is a discount there. But let's take a closer look and see. And the reason I look at 7 years because they fast graphs includes the 2 months forward. So that's truly my 5-year period. So if I look at the 11, this will give me closer to a 10-year average. Again, 11.2, 11.7. So when we look out over the extended period, it's pretty much the same. And the last time that we got valuations relatively in the single digits was the pandemic here. So does it look incredibly cheap at 9.2 times versus 11? That's not crazy. If it got below 9 times, this is going to show up on my watch list item to take a second look at. So I'm not ready to jump into it just this instant, just given where we're at. But definitely one to have on your watch list here, especially, if it's below your cost basis and it's a company that you're high on. Why don't you nibble? Do some dollar cost averaging here. See if you get it below a 9 times multiple. It's definitely headed that way. If it gets down to the September 2022 lows, then that's right around that range. 8.9 is when all the buyers kind of stepped in, and from there you saw the bounce. So it kind of trades very closely in that range. So that's kind of my thoughts without looking into it and doing a deep dive right now. there on Eastman. So definitely a good question there. James, more ranking videos. Okay, you guys like the ranking videos? I can definitely do more of that. What else? Insider info before it hits nationwide news would be cool. And then you will see me doing YouTube videos from jail. I don't even have inside info. When I worked at Ernst & Young, then you're auditing financial statements. So you kind of see what are the results prior to them issuing financials. So there's a lot of regulations around there. You can't trade any stock that EY has for an audit client, regardless of whether you're on that client or not. So for years, Apple was audited by EY. They may still be, but I was never allowed to buy Apple. So there's a lot of regulations around that inside info stuff. So awesome. Drew, see you later. Thank you. I love the dividend videos. A good way to build wealth little by little. However, news on Warren Buffett buys or any other big fish in the industry sounds great too. Awesome. Thanks for the feedback. Bought SCHD, Vici, and AMT today. Awesome. All whole shares and fractional shares of Lowe's is one I like. Good evening, good sir. Do you think AGNC would have a good future? Not a stock that I like. I know the yield looks great. Not one that I'm all that crazy on. Thoughts on the move by XOM? Yeah, so Exxon made their acquisition yesterday. I thought it was a good acquisition. Now, usually, companies do dip. They acquire the company making the acquisition do typically dip on that. So that was the reason for the dip yesterday. But a lot of people, especially pioneer investors, were hoping for a lot higher buy price. So when you look at that and see that and hear it from analysts as well, I like that from Exxon's price, diversifying and building up their portfolio even more. Don't own Exxon myself individually. I own the XLE, which is made up of 20% Exxon, 20% Chevron. That's kind of my exposure there. Although I'm still in that oil and gas one I've kind of told you guys about, IEO. That cuts out those two big ones since I have it in XLE, and it brings those other oil and gas refiners, producers, and stuff in one ETF. That's one I've been making some money on there and really like that one. Just in the short term, not a long-term investment for me. Energy never is. Love these videos here. Awesome. Thank you. Not what I meant. What did you say? Oh, I know. James, you got your full 60 minutes. May even get a bonus minute or two. That's right. We're at over 2 minutes now, Jim. And James, let's go. Thank you. Jim Kramer thinks it might be tough to get approved, but I like it from PXD stance. Thanks, Mark. You bet. And then last one here. That's true, Mark. Soldiered it through. You can start to hear it now. Starting to go. So awesome. So that wraps up our Dividend Power Hour. I made it through, even with the voice. I'm going to fix that link down below. So if you guys are interested, make sure you sign up. You can get some time on my calendar here in the future. We open it up about 5 days. And again, we open it up to 7 people. As of Monday, we opened it up fully again for 7 folks, and we're already down to 5 spots right now. So we've already had 2 signups. So if you are interested and you are serious about really understanding and learning how to invest, definitely check out that evaluation for more information on how we can get you signed up for the next one here. So thank you guys for joining. Again, I really appreciate the support as always. A lot of the regulars here, I truly appreciate speaking with you and seeing you guys in there every day, and the new folks that come on. I really appreciate that as well, and hope to see you in future Dividend Power Hours. So with that being said, I hope you guys all have a safe and wonderful weekend, and we'll see you next week. Take care.